Hello everyone, welcome back to the channel. So today we're going to be talking about how your cash and investments are protected under EU law and otherwise. The inspiration for this video came from a recent question that I got from a viewer who wanted to know how safe their investments were in the hands of a broker. In other words, if the broker went bankrupt, what would happen to their investments? Instead of just answering this question, I thought we could cover the full spectrum of protections that you as a consumer are offered when you choose to deposit money in a bank or make investments with a broker. There will be 3 sections to this video, all of which will be timestamped for your convenience. In the first section, we'll talk about how regulators ensure that only the most high quality banks and brokers are allowed to operate within the EU. In the second section, we'll talk about how your bank deposits are protected in the event of a bank's failure. And in the final section, we'll talk about how brokers design protective mechanisms for your investments and the protections that you're afforded should those mechanisms fail. Let's get into it. Alright, so let's start off by talking about how regulators ensure that only the most high quality banks and brokers are allowed to operate in the first place. Governments worldwide regulate financial service providers in order to prevent failures that could damage the economy and cause financial loss to consumers. The best example would be the financial crisis of 07-08. To mitigate the risk of something like that from happening again, regulators apply stricter rules to financial service providers, essentially dictating what they can and can't do. The priorities for any regulator are A, protecting the stability of the financial system as a whole, and B, protecting consumers from loss. It's typically the responsibility of a nation's central bank to regulate financial services firms, and they do so using 4 main types of regulation. The first of which is structural regulation. The purpose of structural regulation is to ensure that only those with the necessary competence and experience can set up a financial services firm. Essentially, the regulator needs to be of the opinion that you're qualified to run the business that you're proposing and that the business proposition itself is compliant. You see, not every Tom, Dick, and Harry can set up a financial services firm. You need a license, and the barrier between you and your license is the structural regulation imposed by the regulator. This is known as the authorization process because the regulator needs to authorize the business to carry out its operations. And make no mistake about it, this is no easy process, and in some countries it can take upwards of a year to complete. This is an extremely important part of the regulation process, especially in the EU. Once one EU member state authorizes a financial services firm to conduct its business, that firm is usually free to conduct equivalent business in other EU markets. This is called passporting. That's why an online broker like DEGIRO, who is authorized and supervised by the Dutch regulator, can offer its services in Germany, Austria, France, Belgium, Ireland, Spain, and Italy without the need to be separately authorized in each of those countries. So each European regulator has a responsibility to all of the other regulators to ensure that their standards for authorization are high. The second type of regulation is prudential regulation. The purpose of prudential regulation is to ensure that the financial services firm is always able to meet their financial obligations to their customers. What if something happened tomorrow which caused a spike in bank withdrawals? Would the bank have enough free cash on hand to service all of those transactions? Prudential regulation seeks to ensure that it would. The same thing applies to brokers. If a large number of investors choose to sell their investments and withdraw their cash, would the broker be able to fulfill those requests? Prudential regulation seeks to ensure that it would. It really boils down to asking the question, when you, the customer, want your money, can the financial services provider give it to you? And can they give it to you when lots of other customers also want their money? That's the whole point of prudential regulation, and the responsibility to enforce it lies with the regulator who first authorized the financial services firm. So again, one regulator has a responsibility to all of the other regulators to ensure that this is done to a high standard. The third type of regulation is conduct of business rules. Essentially, these are the rules which govern how a financial services firm may and may not interact with you, the consumer. Everything from the way in which they handle your business to the information that they disclose to you is governed by these conduct of business rules. A financial services firm must comply with the conduct of business rules that are imposed by the regulator in each of the countries that it operates in. So unlike structural and prudential regulation, which is imposed by the regulator regulator who first authorized the firm, conduct of business rules are imposed by multiple regulators depending on where the firm is operating. In Ireland, our conduct of business rules come in the form of the Consumer Protection Code. So any European brokers operating in Ireland would have to comply with the rules set out in the Consumer Protection Code. So you can see how these regulations strike a balance between protecting the stability of the financial system while also protecting consumers from financial malpractice. The fourth type of regulation is systemic regulation, otherwise known as macroprudential regulation. These are rules imposed by regulators for the sole purpose of preventing future financial crises. Earlier we mentioned the financial crisis of 07-08. Well, in response to that, the Central Bank of Ireland introduced macroprudential regulations with respect to mortgages, specifically limits on how much an individual can borrow to buy residential property. Irish mortgage applicants will be familiar with the loan-to-income and loan-to-value limits. The purpose of those limits is to ensure that A, Irish people aren't exposing themselves to excessive amounts of debt that they can't afford, and B, that banks aren't making bad loans that could jeopardize the property market as well as their own solvency. Regulators worldwide will introduce macroprudential regulation wherever they believe a vulnerability exists within the financial system. So as you can see, between structural, prudential, conduct of business, and systemic regulation, there are lots of rules in place designed to mitigate the chances of a consumer losing money with a financial services provider. Any regulated company offering financial services has gone through the trials and tribulations associated with becoming and staying regulated. That's not an easy task for the company, and it's not one that regulators take lightly. So remember that whenever you feel apprehensive engaging with a regulated financial services company. But what happens when the regulations themselves aren't enough to prevent a consumer loss? What happens to your money when a financial services provider goes under? This is where specific consumer protections come in, and the protection that you'll receive will depend on whether we're dealing with a bank or a broker. Let's start with banks. When you choose to leave your cash on deposit with a bank, your money is protected in the event of the bank's failure. This is what's known as a deposit guarantee scheme, or DGS for short. Deposit guarantee schemes are required under EU legislation, meaning every EU country is obliged to ensure that depositors are protected. In addition, the level of protection offered under a DGS is harmonized across the EU, meaning the same level of protection is offered to all EU citizens irrespective of what country they reside in. So how much of your money is protected? EU legislation requires deposits up to the value of €100,000 per credit institution to be guaranteed, meaning if you have less than or equal to €100,000 in deposits with a particular bank, the full value of those deposits will be guaranteed in the event of the bank's failure. In other words, you can expect to get all of your money back if it's less than €100,000. If you had more than €100,000 on deposit with one particular bank, the maximum you will receive back under the DGS is €100,000. That's why it's a good idea to spread out your deposits across multiple different banks if you're planning on having more than €100,000 on deposit. That way you can avail of multiple DGS claims and have most, if not all, of your deposits guaranteed. As of right now, a DGS claim would be paid within 10 working days in the event of a bank's failure. Starting from 2024, that will reduce to 7 working days. If you have a joint bank account with your spouse, for example, the account is covered by the DGS up to €200,000, with each account holder being entitled to 50% of the DGS payout, i.e. a maximum of €100,000 each. There are some important caveats associated with deposit guarantee schemes that are important to be aware of. Firstly, it is possible to get your deposits guaranteed with one credit institution up to the value of €1 million for a period of 6 months in special circumstances. The point of this exception is to cover individuals who receive an exceptionally large deposit at the same time that their bank fails. For example, money received from the sale of a house, insurance claims, retirement benefits, redundancy packages, inheritances, and state benefits. If the value of these items once deposited exceeds €100,000 but are below €1 million, they will be guaranteed for a period of 6 months from the date of deposit in the event of the bank's failure during that period. It's also important to note that the €1 million limit does not apply to deposits from injury compensation, but the 6-month time period does. Secondly, deposits made by financial institutions, pension schemes, and retirement retirement funds are not covered by the DGS. So if your pension is being invested partly in bank deposits, just know that in the event of the bank's failure, that will result in a real investment loss for your pension. Thirdly, for sole traders, your personal and business account with the same bank are combined for the purposes of the €100,000 limit. However, if you decide to incorporate your business, your personal account and company account will be treated separately. Finally, if you have deposits with a branch of a foreign bank, those deposits are covered by the equivalent DGS offered by the foreign bank's home state. In other words, if you're Irish and you have deposits with a branch of a German bank operating in Ireland, your deposits are covered by the German Deposit Guarantee Scheme and not the Irish Deposit Guarantee Scheme. This doesn't really matter too much because the level of protection is €100,000 throughout the EU. But in the case of UK branches operating in EU countries, your deposits are protected up to the value of £85,000, which is around €100,000, but is obviously subject to changes in value between the euro and the pound. The other point to note, and this is top priority for EU regulators, is that the money used to cover DGS payouts is paid for with contributions from all banks, not taxpayer money. So it isn't the taxpayer picking up the bill for DGS payouts in the event of a bank's failure. Now let's talk about brokers, the likes of DEGIRO, Book0, Trading212 and Trade Republic. How is your money protected in the event of a broker's collapse? There are two main points to consider here. Number one, how is your money protected when it is deposited onto the brokerage platform but not invested? And number two, how are your investments protected once your money has been invested? Starting with the first scenario, where you have deposits on the platform that aren't invested, your money is covered under the deposit guarantee scheme applicable to the bank with whom the brokerage platform stores your deposits. Brokers are not banks. Therefore, it's necessary for brokers to partner with banks in order to store your deposits before they are invested. Some brokers will also have a banking arm to fulfill this obligation, for example, DEGIRO. But the main point is that your deposits are covered under the DGS just like how they would be when depositing with a bank directly. Therefore, you can expect to receive your deposits back within 10 working days in the event of a broker's collapse. So there is no difference safety-wise between depositing your money with a traditional bank and depositing your money with a broker. That's the main point. But what about your investments? How are your stock and ETF investments protected in the event of your broker's demise? To explain this, I'm going to use DEGIRO as an example. DEGIRO uses what's known as asset segregation to keep your investments safe in the event of DEGIRO's failure. Asset segregation effectively means that DEGIRO holds all of your investments in a separate company whose sole purpose is to passively hold those investments. Because this company is separate from DEGIRO, that means that in the event of DEGIRO's failure, your investments would be protected. And for any of you wondering, no, DEGIRO does not own the company that holds your investments. Because the company is set up as a type of special purpose vehicle or SPV under Dutch law, it has no shareholders. Therefore, it's completely independent. However, there are two important things to note. Number one, the SPV itself will hold your investments with third parties. When you invest using an online broker, there's what's known as a custody chain. The word custody is defined as the protective care of something. So when we're talking about a custody chain for investments, we're referring to the sequence of third parties who are in some way responsible for the protective care of your investments. DEGIRO gives the example of someone investing in Japanese shares using DEGIRO. First, a Japanese broker will buy the shares on the Japanese market at the instruction of DEGIRO. Second, the Japanese broker will assign ownership of the shares to a Japanese custodian. A custodian is an entity who has the responsibility of protecting your investments. The shares themselves will be held at the Japanese Central Securities Depository or CSD, and it's the CSD in most cases that will be listed on the shareholder register of the company whose shares you're buying. Third, the Japanese custodian will assign ownership of the shares to DEGIRO's custodian. And finally, DEGIRO's custodian will assign ownership of the shares to the SPV, at which point the shares will be reflected in your portfolio. So in that sequence, we have a Japanese broker, a Japanese custodian, the Japanese Central Securities Depository, DEGIRO's custodian, and the SPV. So it's not the failure of DEGIRO we care about, it's the potential failure of any of the third parties in the custody chain. DEGIRO does specify demystify that they require their partnered brokers and custodians to use asset segregation in order to protect your investments from their respective failures. However, DEGIRO does note that asset segregation rules are different in every country, and in some cases it may not be possible or legally required. Therefore, if a third party in the custodian chain fails and they don't use asset segregation, that could result in a loss of investments, even if DEGIRO themselves haven't failed. So when you're picking your broker, you want to make sure there's as much asset segregation as possible. It's fundamentally important. The second thing to note is that under DEGIRO's terms of service, and this is applicable to most if not all brokers, you give DEGIRO the right to use your investments that are held with the SPV. Specifically, you allow DEGIRO to lend out your investments to third parties. This is what's known as securities lending. They do this in order to generate more revenue, which is a big part of the reason why online brokers are able to offer low-cost investing in the first place. The entity who is borrowing your shares from DEGIRO is engaged in what's known as short selling. You might have seen the movie The Big Short, or you might recall the GameStop short squeeze at the beginning of 2021. When you short something, you're trying to profit from that something decreasing in value. To do this, you simply borrow stock in the company you're looking to short, you sell that borrowed stock there and then on the open market, and in theory, when the stock decreases in value in the future, you buy back the stock at the lower price, pocket the difference as profit, and return the stock to the lender. All the while, the lender, who in this case is DEGIRO, is collecting fees from the borrower. The question that matters most to you, the rightful owner of the shares, is what happens if the borrower goes bankrupt? What happens if they can't buy back the shares in order to return them to the SPV? There are two protections in place to mitigate your losses in the event of this happening. Number one, when the shares are borrowed, DEGIRO will require the borrowing party to send collateral to the SPV. Collateral can be either cash or stocks that the SPV can use in the event of the borrower's bankruptcy, similar to how a bank can claim your home if you default on your mortgage. Number two, DEGIRO is always the SPV's counterparty when your shares are lent out. Essentially, that means DEGIRO is guaranteeing the return of the lent securities in the event of the borrower's bankruptcy. So it will be DEGIRO and not the SPV that would take the hit. So what that means for you is that your investments are only at risk if both DEGIRO and the borrowing party declare bankruptcy at the same time. And if that happens, your loss is limited to the difference between the value of the shares that were lent out and the collateral that was provided to the SPV by the borrowing party. I know all of this might seem complicated, but just know that brokers put these mechanisms in place to protect your investments, and the more protective mechanisms there are, the better. But what happens if those protective mechanisms fail? Is there any recourse for investors? Similar to the DGS, the Investor Compensation Scheme, or ICS, is EU legislation which requires investors to be compensated when they sustain financial loss from the failure of a financial services firm. Again, this is a harmonized piece of EU legislation, meaning it's the same for all EU citizens irrespective of where they reside. The compensation available is 90% of the investor's loss, subject to a maximum compensation of €20,000. So again, there's something to be said for diversifying the brokers you use to make investments so that more of your investments are covered by the ICS. ICS compensation is paid for by the firms themselves and does not rely on taxpayer money. The ICS doesn't cover deposits, it doesn't offer compensation for losses arising from bad advice, and it doesn't compensate investor losses arising as a result of normal market fluctuations. However, it's important to note that you can seek redress for losses arising from bad advice from your financial services and pensions ombudsman. So that's how your cash and investments are protected under EU law and otherwise. The biggest takeaway here is that when you're dealing with a regulated financial services provider, there are lots of protections in place to serve your best interest. Harmonized protections for bank deposits and investments ensure that consumers will always have some level of protection irrespective of what financial service provider they use. However, some banks and brokers are going to be of higher quality than others. That's just the nature of business. Regulators set the minimum standard, but naturally some providers are going to go above and beyond that standard, while others won't. Ideally, you want to pick the bank or broker who has the best internal mechanisms to prevent a financial loss from ever happening. Granted, that is easier said than done, but you can take comfort in the track record of financial services providers who have been around for a long time with no disasters. Or you could simply use multiple banks and brokers to not only avail of multiple harmonized protections, but also to lower the risk of having all of your eggs in one basket. So I hope you found this video useful. If you did, you can show your support by leaving a like on the video and subscribing to the channel. If you have any questions on anything that was covered in this video, please do not hesitate to leave a comment down below. We did cover a lot and I want to make sure that everything is crystal clear. If you want to learn about the optimal way to save your money, check out the video on screen now. Thanks for watching and I'll see you soon.